In Chapter 12, we're going to look at the way in which incomes are earned and how incomes are earned relates to questions of inequality and poverty. We're really going to do this in sort of two halves. There's this lecture which will talk about sort of the economic theory that helps us understand how incomes are earned, and then there is a separate page on Blackboard that you need to go to after watching this lecture that has links to 4 different lectures out on videos out on YouTube, and ask you some questions about those. You need to watch all of those, as well as one additional supplementary lecture, video lecture from me. There's a lot of complicated questions in this chapter and these issues, and I want to make sure you get a wide range of perspectives. And the other difference this time is that in the discussion forum, I'm not going to put a specific prompt. I have put one in the page that has those other videos. I want you to just think about, as you watch this and as you watch those, what is it that you think about inequality right now? And then let's see later on, by the time you get through all the materials, whether your views on inequality have changed, and if so, how and why, and so on. So that's what we're going to do. Let's start, by the way, with an important sort of consideration. This chapter is titled The Distribution of Income. But despite that, it's important to understand that income is not distributed in the way, say, that parents distribute pieces of chicken to children around the dinner table. There's no distributor of income. There's no person or group who decides what everybody's income is. Incomes aren't the product of anybody's intentional decision, as we've stressed so often this semester. People's incomes, it turns out, are the unintended consequence of a whole bunch of choices made by a whole bunch of different people. So even, including, by the way, you, as you know, if we think about what determines your income, your choices do matter, but they're not the only choices that matter, as we'll see. And so one way of thinking about this is that distribution and production and exchange are not separable in the marketplace. It's not like we produce a pie and then we divide it up among people. Rather, the act of producing the pie determines its size, and the size determines the slices people get. The size of those slices, of course, in turn affects how the pie gets made and how much pie there is, right? So this whole thing is wrapped up with each other. Remember, policy is about rules of the game, not particular distributions. It's about the rules under which we interact with each other, not determining who slices this size or that size or the other size, right? So, again, thinking about income, it's not as if we sort of, bake a pie and then divide it up. In the very act of getting the ingredients together to make that pie, we're already determining who's going to get what size slice out of it, what people's incomes are going to buy, what people's incomes are going to be. So one way to see this is that the pattern of incomes across the market is the result of the interaction of the supply and demand for productive services. Now, what do we mean by productive services? In some sense, all we mean by productive services are things that people demand. And what I mean by that is that if some people think a set of services can help them achieve a goal, then those are productive, right? So productive services here can include human labor, a machine, savings, right? All the sort of ingredients, right? That all the things we would need, all the inputs we would need to engage in some process of production. So what does this imply? One of the things it implies is if you want to earn an income, you have to own some productive services, right? That is, you have to be able to have something that will help someone else produce what they want to produce. And you're probably thinking, well, okay, that probably means material and financial resources. That probably means you got to own a big machine or a factory, or you got to have lots of savings or lots of other financial resources. Turns out the truth is that the majority of income comes from neither of those. The majority of income comes from people's what we call human capital. Okay? Now, if we think about that word capital, which we've talked a little bit about already, if we think about capital goods, what are they? They're simply goods that we've produced goods that can be used to produce future goods. A computer is a capital good. A machine in a factory is a capital good. All right. All the raw materials and natural resources we use are all capital goods. Okay. So yeah, machinery, buildings, all of those things. But what else? Well, what about the knowledge and skills that people accumulate through education and training and experience that enable us as workers to supply valuable productive resources to others? That is what we call human capital. All the knowledge and skills and experience and all the education and training that I've had and accumulated over the years as a college professor, right, enables me to provide valuable productive services to Ball State University. Ball State hires me because they believe anyway, I hope they're right, I think they're right, but they believe, right, that I have a high level of human capital. I'm highly skilled, I can do these things very effectively. I've created those skills over the years through education. I got a PhD, through training, things I went through in graduate school and beyond, and experience. Been teaching for 30 years, right? So that human capital, that's what we call human capital, the skills, the knowledge that people have that enable them to be productive. And it also turns out that when we look at national income figures, compensation of employees, that is the income and other benefits that employees get, dwarfs corporate profits by maybe 15 times as much, right? If we think about the percentage of those various things, something like 70% of national income goes to employees in the form of wages and compensation, whereas profits are under 10%, right? So if you sort of think about that comparison, right, we tend to think profits are enormous. They're not, right? Profits are actually pretty small as a percentage of national income. Meanwhile, the percentage of national income that goes to us in the form of wage payments, right? And we think about the average firm, about 70% of what their expenditures on inputs is to their workers. Okay. So what does it mean to say that human services, human productive services, are produced goods? We do invest in our human capital. Examples of investing in your human capital? What you're doing right now, going to college, right? Getting that education, that's part of improving your human capital, making you more productive. Right? The prospect of greater income does put pressure on us to acquire capabilities that will better permit us to supply more valuable services to others. Right? If we want to earn higher income, we need to invest in ourselves so we can provide the things that other people want. Let me note, by the way, right, that there's two notions of these notions of productivity and what people want are separable things. Right? We can talk about sort of your technical, physical productivity, right? That part of certainly what matters for the wage you earn, okay, is how effectively you can, how quickly you can produce things, right? This is sort of your marginal productivity, right? How, if I put you in with a group, how much will the group's productivity increase, right? How much can you produce? But the other part of that is, what's the value of what you're producing? You might be really, really good at producing something that people don't value very much. Suppose you're a really, really talented musician, but the instrument you play is something rare and strange and maybe old-fashioned, right? You might be really, really good at it, but there's not much demand for it, so you're not going to earn a very good income, right? If you're really good at making horseshoes, right? Okay, you're really skilled, but you're not going to make a great income. On the other hand, if you're in the tech world, if you can code, you don't necessarily have to be the world's best coder. You can be a good one, but the demand, the value in the marketplace of that activity is very high. So it's both a matter of your productivity, but also the value that other people attach to that productivity. So as you guys are thinking about, what am I going to do with my life? How am I going to earn income? Both of those questions are important. You want to be the best you can be at the thing you're doing. But if you also might want to think about, is the thing I'm doing something that other people are going to value? Are those productive services that I can create valuable to others? And from your perspective, right, if you're going to invest in your human capital, you have to believe you're going to reap the returns, right? You have to believe that if I spend the time getting an education, it's going to be worth it down the road. And college educations usually are. But you might think about the way that the rules of the game can affect that. Suppose we raise tax rates. Right? You might think, well, is it really worth it for me to invest in earning a higher income if I'm not going to keep all of it? Right? Also, your time preferences matter here too, right? You guys are investing in yourselves as students, and for many of you, the first 21, 22 years of your life, you're not working a whole lot, and you're hoping that all that investment in your education will give you a higher income down the road. Other people might be less patient. They might say, I can't wait. I want to get out in the working world now. So to some degree, one's income will depend upon one's time preferences and one's patience. The other thing to keep in mind, third thing to keep in mind, is the importance of lifetime earnings. Is a medical student really poorer than the garbage collector? Right? Medical student's income isn't very high while they're a student. Garbage collector might make a higher income, right, while the medical student is still in school. But when we start to think about the human capital of that medical student and what that investment will mean down the road, right, looks very different. It's also true that people tend to increase their earnings over the lifetimes. We peak in mid-career, right? So again, as we think about early in one's life, right, we expect people's income to be lower and we expect it to grow over time. Right? One quick thing we might talk about here is, how do firms choose between machines and workers, right? one of the things that people frequently argue is that machines, and we're thinking about this with robots now, destroy jobs because they're more effective, more productive than people. First thing to understand is, by the way, robots are nothing different than a hammer, right? What all machines do is replace human labor. That's why we like them, right? That's what they're good for, okay? We only replace the labor with a machine if we think the machine will be more economically efficient. That is, will be more worth it to use. If the returns from the machine, again, considering costs, are greater than the labor, we switch. And as human labor gets more expensive, as people get more skilled, it creates an incentive to find mechanical alternatives. But as we find mechanical alternatives, that labor is freed up to be used in other places where its benefits are greater than its costs. Right? The more work that we can get done with machines, the more new work, additional work we can accomplish with the released labor. Think of this. If we wanted to end unemployment, right, one easy way to do it would be to destroy all the farm machinery and send everyone back to work on farms. We can get rid of unemployment that way, but would we be better off? I think we'd be worse off, right? All of that labor that would be used on farms, we don't need to use there. We know that there's machines that can do that work, right? And the great story of the 20th century and 19th and into the 20th century was the release of that agricultural labor into the industrial world and then into the service world, and now into the tech world, into the knowledge economy. The reason we have coders and web designers and so on is because we don't need human beings in the factories as much anymore. We don't need human beings in the farms as much anymore, right? If we can do it without humans, that's a good thing, okay? One of the key concepts to understand here as we think about this, and we've sort of suggested it already, okay, is the idea of derived demand. Okay? So the key to understanding the determination of income is that it's, again, as I said earlier, the relationship between the physical productivity of your human capital and the value of the services that your human capital provides. Because our wages depend upon the value of what we add to the value of the final product, we can say that the demand for productive services is derived from the demand for the final product. To put that differently, goods don't have value because labor was used to make them. Labor has value because it's being used to produce a good that others think is valuable, right? It's the subjective value of the final good that determines the value of the labor that goes into it. The demand for the inputs for the productive services is derived from the demand for the outputs, right? Why do fancy chefs get paid more than the cooks at McDonald's? Because we value the thing they produce much more, right? It's not, right, that the food at the fancy restaurant is more valuable because the chefs have more human capital, right? That the chef's labor is more intense or whatever it might be, right? And McDonald's the food's cheaper because there's less labor involved. That's a fallacy. That's the labor theory of value, and it's simply wrong, even though you guys tend to believe it about how much work you put into papers and tests and so on. It's the reverse, right? What determines the value of labor, your labor included, is the value of the final product that you produce. So again, as we were suggesting earlier, right, there are certain kinds of fields where the final product's more valuable, and that, all other things equal, is going to increase the value of the labor of the workers who produce that. If you're working in a field where the output isn't very valuable, your salary is not going to be very high because the value of your input, if you as an input, your human capital, depends upon the value that people place on that output. So that's the idea of derived demand. The demand for inputs is derived from the demand for from the outputs they produce. That is, it's the final product, it's our subjective evaluation of the final product, of the consumer good, that determines the value of the inputs, not just the human capital, but also the machinery and so on that go into making it. And notice how this brings us full circle. Income isn't distributed. It depends upon the value of the output labor produces, which itself is a product of the interplay of millions of suppliers and demanders, right? What determines the value of the output? Well, people evaluate, do I like the McDonald's food better than I like the fancy restaurant? We make those evaluations, we make those decisions. What we buy and sell partially determines people's income, right? And also the decisions people make about investing in their own skills matters here too. The interaction of all of those things, the unintended consequence of the interaction of all those things, are what produces income. Again, it's not the deliberate result of some distributor's decision. It's not the deliberate result even of the boss's decision, right? When employers pay you a certain amount, right, they are constrained by market forces as well. They're constrained by their own search for profit. They're constrained by what the market pays for that kind of labor, right? So your income, my income, everybody's income is an unintended consequence of the ongoing operation of the market economy. That's important to understand when we start to think about inequality, right? What it suggests is that where inequality largely comes from is from people having different human capital and producing outputs that are valued differently, right? It also, as we'll see in the case of something like the gender wage gap, depends upon the other kinds of choices people make about the kinds of jobs that they like too, right? If you prefer a job, for example, with more flexible hours, probably going to see lower wages, all other things equal, right? And if it turns out that there's patterns to how people choose those jobs, there'll be patterns to the incomes that they earn as well. So the key thing to think about as you go and watch these other videos about inequality is to remember, right, there's no distributor, right? Income isn't distributed. Income is the unintended consequences of the interplay of our decisions about our own human capital and the demand for our productive services on the marketplace, right? And if there's patterns in the choices people make about human capital and patterns in the choices they make about what kind of jobs to pursue, there'll be patterns in their incomes as well. So hopefully, right, this quick overview of some of these issues that are raised in this chapter, the theoretical issues, will help you understand those videos with a more critical eye and get you thinking about inequality in some ways perhaps you haven't before. So again, having watched this, please go now watch those 4 videos on inequality and then head on over to the discussion board and share your thoughts.